All right, Jedi options, per Matt's intro there. Topic today is rolling up covered calls. So we're going to get into covered call management here. And this is a very timely topic because the market is breaking out. Part of the reason why I brought this up to Matt was because I've got some covered calls that are in the money and you got a decision to make as to what you do here. But let me take a step back and set the table here. So topic again, rolling up covered calls. You have two approaches for covered call management. Okay. And in fact, let me take a further step back. Okay. Let's make sure we're on the same page here. A covered call is you're long 100 shares of stock and you sell typically like a 1 month, maybe 30 days. Most common would be to sell it out of the money call option, maybe a 30 or 40 delta call option. And the idea here is I sell the call, I get paid some money. I'm obligating myself to sell the stock. So you are making a promise. Hey, you can buy my stock from me. I'll willingly cap my gain in the stock. That's what you're giving up. Okay. In exchange, you get paid some money, which we call cash flow, right? It acts as cash flow. If the stock goes sideways, you're getting paid. It also protects against a loss in the stock, right? So you get a little bit of downside protection. So cap the gain, cap the upside gain in exchange for downside protection and cash flow. That's the trade-off, right? That's the deal you're making. Well, there's two ways that you can manage the trade once you're in, right? One, I'm going to say is the more passive approach, which is kind of like set it and forget it until expiration, where you can basically just say, listen, I'm a busy man or I'm a busy woman. I've got stuff to do. I'm just going to sell a 30 delta covered call and I'll come back in a month and deal with it at expiration. If it's in the money, I'll let them take my stock. If it's out of the money, it expires and I'll sell another one. I'm not going to do much in the interim. Okay. I want this to be a very passive, hands-off thing. You could do that. Or you could be a little more proactive in the way you manage it, responding to market signals, trying to skew it a little more bullish when the market gets bullish, trying to skew it a little more bearish when the market gets bearish. If I feel more confident in my chart reading and my ability to make timely tactical decisions, I'm probably going to be a little more active, right? So I could adjust the call strike higher or lower as market conditions change. And the key signal for me there would be breaking support or resistance. So conceptually, when the market breaks support, I want to play a little more defense. Okay. I want to emphasize the protection aspect of the covered call. Okay. And then when we break resistance, I'm going to get a little more offensive. I'm going to raise the cap in terms of where I have to sell the stock at. So this is fairly straightforward. When we break resistance, I'm thinking about raising the call strike. We call that rolling up. Okay. When we break support, I might consider lowering the call strike, which is rolling down. This is playing defense, and I get a credit when I roll. Okay. I'm bringing in more money. This is playing offense, and I usually have to pay a debit to roll, but I'm opening up more profit potential in the stock. Okay. It's effectively what I'm doing. So let's draw a little picture here, and then I'm going to show you an example. And again, the reason why this is relevant today is because the market's breaking resistance. And so you got a choice to make. Okay, so let's say your situation is, I'm actually going to draw a little chart here. Maybe the stock looks something like this. And this is when you're entering. Okay, so you're long the stock at $100 and you're short a call option up at I'm actually going to put it here. I'm short at 105 call. And let's say I sold that for $1, just to make the math easy. So I got $1 credit when I sold it. Again, I could be passive. I could say this is a 30-day trade. I sold it. I sold an August covered call, and I'm just going to come back in August and see where it's at expiration, win, lose, or draw. or I respond to market signals. So in this case, if it breaks this prior support pivot, I might want to make an adjustment to the trade. Or if it breaks the resistance pivot, I might want to make an adjustment. And so in the case of it being bullish, which is what we're dealing with right now, let's say this $100 stock goes up, it gets to 105, which coincidentally is also the strike, but it's more the resistance level that I'm keying in on, and it breaks through resistance, okay? And here I am capped at 105. I can't make any money above 105. And as is the case right now in the market, we still have like first option. I've effectively capped my gain for the next 30 days. Listen, the stock market, 30 days is a long time. If the market keeps ripping for the next 30 days, I have to ask myself, do I really want to have a locked down, locked in, capped risk graph or capped profit potential for 30 days? It'd be one thing if I had 5 days left, but 30 days out, I'm even more apt to adjust the trade to open up the ceiling and make a little bit more. Okay. So the situation, let's say stock runs to 106, my 105 call is in the money and I still have 30 days left. I want to close that. Let's say that the call, I sold it for $1. Let's say it's now trading for 250. All right. So it's now 250. If I buy that back, I'm going to have to pay 250. Okay. So that's step one. I'm going to buy back the AUG 105 call. And what I might do is push it up and sell an AUG 110 call. So I have August here. Okay. So I'm going to come in, I'm going to buy this guy back, effectively losing on that short call. That's fine. I just made a bunch of money in the stock. And then I'm going to sell this new 110 call. And I don't know, let's say I get $1.50 credit. So I'm going to sell that guy. Well, the act of you buying back the old one and selling the new one, you're going up in strike, right? You're going from 105 to 110. You're lifting the ceiling. It's known as rolling up. And the net cost, in this case, you paid $2.50 to buy back the old one. You got $1.50 on the new one. So you paid $1 debit for the rolling transaction. Okay. And the benefit is you just opened up from 105 to 110 in terms of profit potential in the stock. I've raised the ceiling. Now, in this case, I had to pay a little bit of money to raise the ceiling, but listen, I'll pay $1 debit to lift the ceiling by $5. If we end up going up to 110, trust me, I'll be happy I paid the $1 to roll up to 110. So conceptually, that is what traders are wrestling with right now. I'm going to use IWM as the example here. Let's say in IWM, you have a 180 covered call. And yesterday, remember, you sold this a week or two ago when the market was below the 50-day moving average, just kind of chopping sideways. Market wasn't all that bullish. You felt comfortable being short a 180 call. It was just above resistance. Well, things have changed. We just broke a resistance pivot. You're at your strike price. You have 30 days left in August, the August monthly option, right? So you have 30 days left. And that's a long time. If you think this market rally could have legs, yeah, I think it's 28 or 30 days. I don't want to be capped at 180 when I think it could run to 190 over the next 30 days, right? So what I've been wrestling with, as I think anybody who's more tactical has been wrestling with, is do I stay or do I adjust? And for me, I'm adjusting because I'm not willing to be capped at 180 for 30 more days now that we've broken out. So buying back the 180 and selling something higher, whether it's 185 or 190, it just depends on how much you want to lift the ceiling. That is what I am, have been doing this morning. And it's a judgment call, but you could make it a little more precise if you wanted to create a delta rule. Effectively, what you could do is you could say, well, normally I sell 30 delta calls. And so when the market broke out, my AUG 105 call went in the money and became maybe like a 55 or a 60 delta call. So if I'm going to roll up and I don't want to be overly subjective about it, maybe I just roll up to a new 30 delta call. I close the old one and then I sell a new 30 delta call. I'm a little bit more case by case basis, depending on what the chart looks like. But just to sum up here, I think it's wise when you're doing covered calls, if you decide, A, are you going to be passive or active? B, if you're going to be more active in the management, what are the rules? Because you want to be as consistent as possible. For me, I think breaking a resistance pivot justifies rolling up. Breaking a support pivot might justify rolling down. And then 3, what are you going to roll to? Are you going to use the chart to be your guide in terms of what strike to go to? Or maybe you just reset the delta to a certain amount. I think you do that, and you're gonna be over time, if you believe in the timeliness and effectiveness of using support and resistance as short-term bullish and bearish signals. I think you'll find that you probably do better with covered calls by being tactical, and you at least have fewer instances where you're short a call right here, and by the time expiration rolls around, the stock is so far above that you just completely missed out on a ton of profit. Rolling up prevents that from happening. You have smaller losses in the occasional times where you get hit on the short call.